Sure. Well, I think the market is trading between this 3,000 and 3,100 level on the S&P. And remember, we are up over 40% from the bottom. We're 6.5%, 7% from the all-time peak. So today's action is not unwarranted. The market is not cheap anymore the way it was in March and April. But the market seems to have absorbed the fact that this quarter is just going to be kiss it away, goodbye. It's going to be terrible. The numbers for 2021 are starting to pick up. The numbers for 2022, even if you look at estimates, they're rising also. So there's a discounting mechanism while we've decided that this quarter is bad. Banks, abysmal, of course. Interest rates are terrible. Loans, I mean, really, it's been the worst case possible for financials. Industrial's been awful. Most consumer stocks, utilities terrible. But on the plus side, the COVID-resistant stocks continued to gain attraction to investors. We've seen growth in a number of companies where we wouldn't have known until we'd seen it possible that their markets have expanded. They've accelerated in terms of reaching new audiences, rolling out new digital platforms, whether it's Amazon, Twilio, Microsoft, PayPal, the other payment processors, the type of Zoom, type of telemedicine and meeting companies. It's all been a positive for these businesses, and the market has loved that. And that's why it's trading in a range which is much higher than many people would have expected.
Weiss, what are you looking to do today, if anything?
I'm not really looking to do much. The market needed a reason, and I know people say it never needs a reason, but you just don't go up in a straight line, particularly in this environment. So it's a pause, and hopefully it'll be the pause that refreshes. I wouldn't be surprised to see it go down a little more. We are in the trading range, as Carrie points out, and that's going to stay. If you have any concerns, if you're an investor or trader and you have any concerns about the quarter, you shouldn't be in the market except in the stocks that will perform, which are the technology stocks, which are the 5G stocks. So if the market came down somewhat, and I'm relatively fully invested, I always keep a fair amount of cash, so for me, fully invested is not 100%, I'd be looking to buy some of the Chinese names that add to what I own. I recently added to or bought IQ. I bought Baidu. Very powerful buying going on there, and only a few number of stocks that the insurance companies there can buy. And those are some of the dual listing, the bigger cap stocks. So look, the Trump news did take the market down a little bit. I think that in itself was flawed, that reaction. I think that we went too far on the reopening trades, for sure, and I've been very clear about that. The low-hanging fruit was picked, and it was overpicked, and now it's rotting a little bit. So be in the ones where you can look out and see valuations there. But you're in a valuation holiday. Companies are not going to come out and give you forecasts now for the second half or even for next year because they don't know. It'd be irresponsible to do it. So it's a market that's built on faith. And as I said, if you don't have that faith going out a year, you shouldn't be in the market.
Valuation holiday, I mean, I think it's more like purgatory, Sarat. Companies are stuck between a rock and a hard place when it comes to giving guidance. They may have pulled guidance, when they had their last earnings call, but this time around, I mean, take a look at what happened with Walgreens. Finally did give guidance, and it was way below what the street was expecting by a mile. And I wonder if investors think, this is what we could be bracing for this coming earnings season.
I think you're right on that. I mean, right now, over a third of companies have taken guidance away, and as we go into next week, where we get a lot more earnings from the financials, and then you start getting the core companies of industrials and cyclicals coming out. One of the things to watch for is to say, in previous earnings seasons, you used to say, okay, how are we going to expand operating leverage? How are we going to grow revenues? I think a big focus is going to be on where are costs going to come out of, and I think the market will sense that. And that kind of has some pretty negative connotations going forward in terms of employment, consumer spending. So until we get through this earnings season, it doesn't surprise me that we get this pause, especially in financials, industrial, cyclicals. I mean, financials have their own issues, given that they're not allowed to buy back their stock anymore. They're not allowed to increase dividends, and we just don't know what's going to happen in terms of loans and consumer behavior. So going into this, it does make a little more sense to be cautious And then you get the barbell strategy. I mean, you talk about the stay-at-home stocks, the COVID stocks, on a pure valuation basis. Some of them just don't make sense anymore, even when we look across the valley and say, okay, can they sustain those growth rates, or is this kind of a, hey, we got to have money parked somewhere in the market, and those are much more safer, quote, than being in the other stocks.